Good morning, everyone. It's Monday, January 12th, and welcome to today's edition of 7 Investing Live. It's our live stream event that we host every Monday, Wednesday, and Friday at 10 a.m. Eastern Time to uncover and invest in the stock market's most intriguing opportunities. My name is Simon Erickson. I'm the founder of 7 Investing. I hope that you had a wonderful holiday break. I hope you enjoyed the first weekend of NFL playoffs this past weekend, and I hope you're back in the saddle and ready to start doing some investing here in 2026. And something big happened just recently that we're going to focus on here on today's show, which was our 2025 year in review that we conducted for 7 Investing. This was a big deal because it took a look at every single one of the active recommendations we have on our scorecard. All of the stocks we're actively saying are either a strong buy or a buy or even a hold, and saying, okay, what is our highest conviction ideas in each one of the sectors that we're investing out there? So on today's show, being that we're kind of getting back in the saddle, 2026 is coming up here. Let's take a look at a few of the sectors, sector by sector, and some of the actual investing ideas that we had within those. What better way to promote the year in review than to actually show some of the actual year in review? So before we jump into that, though, I encourage everyone, if you haven't yet, take a look at 7investing.com. This is our service that we've had since March of 2020. So we're coming up on 6 years here now of every single month making an official stock market recommendation and also putting 5 monthly best buys out there. And Heather, if you could so kindly show a sneak peek here of our scorecard, we have actually got at 7investing.com a transparent recommendation scorecard. It shows all of the recommendations we've ever made. It shows the returns of our picks versus the S&P 500 in real time, updated every single 5 minutes, and then actually shows our conviction rating for all of them. And so if you do go check this out, which I encourage you to do, 7investing.com/recommendations, you can actually see all the recommendations I've ever made. This is my name. We filtered there at the top by advisor. And you can see that we're coming up on 100% active or absolute active return for all of the recommendations on the Simon Erickson scorecard. And you can kind of even drill down farther down. You can see actually in the most recent month, here in January 2026, a nice little sneak peek here of the trade desk, which was our actual official recommendation here. And we track them, what is not only the daily trade or the daily change, but it was the total return versus the S&P. How is that looking in comparison? And then the conviction rating. The conviction rating is a key feature of the 7 Investing subscription because it's not just saying, hey, here's 106 stocks. Good luck figuring out which ones to invest in. But it's saying, hey, out of all the recommendations we have, what are the 5 highest conviction ideas that we have? We call those best buys every month. And then what are the 12 at the top of the list as well? We call those strong buys. And this is the full gamut, right? This is across all different investing styles, all different types of risk levels, and of course, all different types of industry sectors. And so for the trade desk, we would call that one a higher risk growth style investment in the advertising industry. But it's not just that we're only investing in growth style companies or just large caps or just advertising companies or anything like that. This is a full scorecard that, again, runs the gamut of all investing styles. So I really encourage you to check out 7 Investing. We've got another graphic here that shows the returns over time. We've been very transparent about this. I think one of the most important parts of investing, if you're doing this right, is being transparent and being honest. Not just kind of doing the hoorah, banging the drum, talking about your winners or only the stocks that go well. We have to discuss, sometimes we pick stocks that don't turn out well either. And sometimes the market just as a whole doesn't want to invest in the stock market, right? Look at 2022. Look at how high we were riding in 2021 versus the interest rate increases that the Fed put out there 7 times in 2022. And really was difficult, not just for our scorecard, but the entire S&P 500. But the way that we justify the 7 Investing subscription of $200 a year, very, very investor-friendly a price point, is the delta between the blue line and the orange line, which is the returns of the active recommendations I have in the scorecard versus the returns of the S&P 500 index. If we can actually generate alpha, and again, this is equally weighted too. If you're actually putting more than an equal percentage in any one of your favorite stocks that does outperform, the delta would be even greater than that. But we're trying to say if you're actually finding the best stock market opportunities, doing the homework, doing the research, and investing in individual stocks rather than just buying an index, you should have alpha of outperformance over long periods of time. And we've certainly shown that, again, coming up on almost 100%, almost a triple-digit absolute return since the time that they were recommended. So please take me up on the offer as we're about to jump into the year in review here in a moment. But please take me up on the offer to check out 7investing.com. We do offer a 7-day all access free trial. gives you access to every single one of those recommendations on the scorecard. Each one of them has got an active report attached to it. Every month has got 5 monthly best buys that are out there, including January here most recently. Um, Take me up on the offer of zero risk, 7 days for absolutely free to check out 7investing. If you love what you see, $200 a year, excuse me, is an investor-friendly price point. We're trying to find the stock market's greatest opportunities. Okay, Simon, awesome, great sales pitch over. No more, twisting of the wrist to sign up for 7investing. Let's jump into the year in review. Let's talk about some actual sectors and the highest conviction ideas in this sector. First of all, this was something we put out in mid-December, right before the holiday. We got that out there, but again, we kind of all, stuffed ourselves on food and family time for a couple of weeks. It's time to come back and take a look at that again. Let's look at the year in review and what we've got. There's 17 different sectors we've invested in the 7investing scorecard. And the year in review itself was 45 slides long. This was comprehensive. This thing was a beast. It was a lot of research and a lot of insights that went into this. But you can kind of see by alphabetically, here's the different sectors we're looking at. And rather than just say, okay, cool, year in review, good luck finding out what's in that, I said, let's showcase some of this. If we're going to alphabetically show these 17 sectors we're investing in, let's take the first one, advertising. And let's take the last one, travel, and actually show what this looked like. Show some actual recommendations, show some of the things going on in the market. We're going to jump into the year in review. If you have any questions live, I'm glad to take those here within the live stream event. But certainly check it out again if you'd like to on your own time to look at the year in review. So Heather, we're jumping right in. We're going to go into this first slide. We're going to look at advertising and kind of an overview of what's going on in this industry, bigger picture, and then let that guide the recommendations that we have here with 7investing. And so, first of all, the advertising industry is massive. This is almost a $1 trillion global industry that's split between kind of traditional linear advertising on television, radio ads, newspaper ads. That's about a third of it. Another third of it is going to things like social, Facebook, of course, a very big deal out there, digital ad platform. And then Google, a search ad kind of platform there. But then also there's kind of another third of this industry that's going to new things like programmatic advertising and ad auctions that are outside of the walled gardens. And so I've always considered the trade desk, which if you were watching here live, you saw a couple minutes ago, was my actual stock recommendation here in January. But I continue to consider the trade desk as really the innovator of this space, saying, hey, we've gone digital with ad spend. That's a huge tailwind that's going for this entire industry. But for the last 16 years of our existence, let's make this an open internet where there's price transparency for ad buyers that are out there. A reminder that if you're out there and you're wanting to buy ad space on the internet, you're a company or an agency that's representing, the companies like Nike, companies like Under Armour, companies like Peloton, the things that are consumer facing, and you want to place an ad in front of a consumer out there. For every dollar you're spending, the publisher that has got the content out there that you're placing the ad into is really only capturing about 55 cents. And there's another 45% that's kind of a little bit less transparent and opaque in this digital advertising industry. It is an inefficient, fragmented market in advertising right now. And the trade desk for almost 2 decades now has been trying to use data to make it look more like the New York Stock Exchange, to make it look more like the auction is fully transparent. You know exactly what you're getting. You know the true prices of the ads that you're buying, just like the true prices of stocks that we're buying on an exchange. You're getting to see as much information as you possibly can and use AI to optimize what you're interested in doing. Just like if we're buying stocks, we want to make sure that not only we're getting a fair price, but we understand all the financials which the SEC gets out there. And truly, this industry that's been fragmented and inefficient can be much more transparent and efficient going forward. And so here's a couple of the other reasons that I think the trade desk is so intriguing right now. They've done a lot of shots across the bow of the industry saying, look, we don't like a lot of the waste and the fraud and the inefficiencies of the existing systems. Maybe we can either change or bypass entirely the current programmatic auction process when it comes to buying and selling ads. So this is very interesting. OpenPath has been one of their new initiatives. We talk a lot more about this in the report. And then on the supply side, the companies like the PubMatics of the world, which is actually a company that is on our scorecard right now. There are others too, Magnite and others that are on the supply side platform. These are the ones that represent the publishers, right? If you're publishing ads or you're allowing ads to be placed into your published content, you want to get the best pricing you possibly can, right? You want to make as much money through ad revenue as possible. there's kind of this interesting relationship between the trade desk, which is independent and only supports the ad buyers on this, and then the companies like the SSPs, the supply side platforms like PubMatic, who are trying to do the best they can for their customers, who are the publishers. So again, there's a lot going on in this space. There's a lot of wheels turning in this highly fragmented ad market. I continue to think the trade desk is the innovator that has been in a challenging market here in 2025. We'll talk more about that in a minute, but I think they are still the lead husky, the top dog in the innovation in this space. Elsewhere within the walled gardens, Amazon has for the longest time really focused on their own properties, right? Amazon Prime, that's their own publishing arm that they want to capture as much revenue as possible. Amazon.com, the e-commerce platform, certainly they're asking vendors to place advertisements within that as well. But Amazon is also opening itself up to the similar idea to what the Trade Desk is doing of a more of an open internet demand side platform. And reportedly, Amazon's DSP is about 50% lower in terms of the pricing and the take rates than the Trade Desk is charging right now. And that's been interesting to see, this new competitive threat going out there and winning new big customers like Walmart.com and Netflix, who were previously working exclusively with the Trade Desk. So perhaps a changing of the guard, at least in terms of not being able to date other people when it comes to the largest and most lucrative customers. And then elsewhere, Alphabet. I mean, if you've been watching what Alphabet has done and how they've handled this existential threat of AI, it has been absolutely amazing. Launched Gemini 3, put it right there in the search bar of Google Chrome, and it's already taking significant market share from GPT. I think that Alphabet is just a perpetual buy in this industry, not only because of the innovation and the neat way that it launches successfully new products out there, but also being very disciplined in capital allocation too, right? Alphabet just kind of previously was hoarding cash. It's been really doing a fantastic job of buying back shares in recent years. It continues to be a shareholder-friendly, long-term, innovative company. And on top of all of those reasons, Alphabet is making its own chips that are now optimized for the machine learning inference that's being used for AI out there, right? Everyone else is kind of, or not everyone, but a lot of large companies are using NVIDIA's Blackwell chips, the Hopper chips out there, because they're wanting to use those to run the AI algorithms for the things that they're wanting to do. Of course, Alphabet has got its own TPUs, its TensorFlow processing units there that can be used for its own models. And any companies that are using similar models for AI, like Meta, might benefit from this trend as well. So a lot going on there, kind of a review of 10 minutes of what's going on in advertising. Let's talk about some stock picks. This is actually directly from the year in review. Again, I can encourage you to check this out on 7investing.com, but we're digging right in. The Trade Desk, just like I said, is my highest conviction idea in the advertising space. Alphabet is in green because even though it's listed as a buy in terms of conviction rating, I think that's buy trending towards strong buy or best buy. I think that's one of those perpetual buy and hold companies in this space, which is really, really strong. Meta has done very, very well for itself. Meta for a while there was getting too controversial and just too cheap, and its stock has certainly bounced back from there. There are questions about how much ad load is too much in that core news platform within Meta's, core organic properties. But that hasn't really been an issue. You haven't seen as many people leave Meta as a lot were initially expecting there to be. And then the new ventures, the things like the metaverse, we don't really know how that's going to play out. It seems like it's perpetually 5 more years, but the company and the stock is still very, very profitable. Meta is a strong buy on the score. It's just a buy that we strongly have conviction in on the scorecard. And I think the companies on the supply side, like I mentioned previously, Magnite and PubMatic, those are a little bit less certain right now. Both of those companies had declining revenue year over year in 2025. They also have less than 100% dollar-based retention rate, which means the companies that were around previously are spending less on their platform in 2025 than they did in 2024. Now, granted, 2024 was an election year. There's a little bit of bias and factors that play into that. But certainly when you see declining revenue and a declining retention, that's a red flag. That's why I've got that marked as a little bit more red. And then we even looked at our sold positions. These are not necessarily Simon Erickson recommendations, but across the full gamut of all the advisors and all the picks that we've had some previous recommendations that we sold. Cardlytics was one that we sold in November of 2022. The stock has certainly fallen a lot farther since then, in the more than 3 years since then. That was a good sell in our scorecard. But we also sold Magnite and Roku and did a little bit of a review on those where it seems like we probably sold a little bit too early, right? We missed a 98% gain on Roku from selling it also in late 2022. So an interesting space. I think advertising as a whole, I'm generally very bullish about this space. It's got strong tailwinds. It tends to be that advertising's going to continue into the future. It's $1 trillion global market right now. We certainly see a lot of those ad budgets moving towards digital and moving towards programmatic and even moving towards the open internet. And it's very attractive profit margins, tend to be 40% plus EBITDA margins for the companies in this space. Heather, my goodness, I'm going to take a sip of coffee at this moment just to catch my breath. But any questions you have that perhaps as an advocate of our listeners about the advertising companies or any of these stocks on this list here?
Well, it would sure help if I could find the show button to unmute myself. I do. Why do you think, I mean, you did kind of hit this. Why do you think that Amazon is taking so much market away from the trade desk? If the trade desk is s- I'm so sorry. Monday morning, the brain's not quite awake yet. If the trade desk is making so much of the advancements, what is Amazon doing right?
Yeah, perfect question and a fantastic ask. Good question on that one. I think that the trade desk was kind of the first and only one to work with when it came to programmatic, right? So this was when I say programmatic, it means you don't have to have any human placing any ads out there. Just you got the right website showing the right ad at the right time. And the trade desk, they were kind of the innovator of this space. They're the first ones to do that. And they had such a head start with all the large companies, Walmart and Netflix included. And those two companies, to be clear, haven't left the trade desk. They're still plugged in with the trade desk platform. They're still using it. Trade desk is still making money off of both Walmart and Netflix. But they've simply said, hey, we're not going to be locked down exclusive anymore. We're going to start dating some other people, Amazon being one of those. And we're going to try to kind of balance both of these in our ad spin. And we're going to see how they compare one against each other. And so, one way of looking at that is very, very negative. Hey, the trade desk lost an exclusive customer that is really large, to Amazon who they're working with. But the other one is it's kind of like competition makes you stronger, right? If the trade desk truly is valuable and its platform is doing better than Amazon in head-to-head competition, maybe it's not really going to lose as much business with those customers as people are initially assuming. But the news itself, tends to be, um, shoot first and ask questions later. The stock for the trade desk certainly suffered here in 2025, and that was one of the biggest reasons, competitive threats. Great question, Heather. I'm going to move on a little bit, and then we'll ask about the second one here in a moment. But we've got about 10 minutes left. I'd like to look at travel, which is alphabetically the last on the list of the year in review. We hit advertising. That was first alphabet. Let's go travel, the last one in the alphabet. But generally, we've seen kind of the travel market moving online. This is another one that it's not just you call a travel agency, you book your hotels and you book your flights through an actual agent that's charging you fees. Over the last decade or so, 2 decades, really, you've got to move this online where you've got these large platforms like Travelocity, like Booking Holdings, like Trip.com, previously Ctrip, where you would go online, you book everything through there. And of course, if you're an airline or you're a hotel chain, you want to be represented on those platforms, and you'll gladly pay a small cut of the total volume to give it to these online travel agencies because that's where everyone's going. That's where the travelers are visiting. And so these are cash flow generating machines. They typically have a user base that's typically loyal. If you're going on booking.com for all of their every time you take a trip, or Airbnb, whatever it is, you tend to go back to the same platform again and again. It's not like if you took, 5 trips in 2025, you're going to take 50 trips in 2026. It's kind of a steady kind of growing business, slow growing. But again, these businesses, you put the money up front in R&D. You got to make sure you've got some customer support and some other things, but pretty low variable cost that tends to generate a lot of cash flow. And so I love that these businesses not only are cash rich, but they're using it to buy back shares and reduce their outstanding share count year over year. And this is something that Airbnb and Booking Holdings and Trip.com, which is China's version of Booking, they're all kind of these perpetual buys. They've methodically used their cash flows in shareholder friendly ways like repurchases and dividends. And I'll highlight Booking first and foremost there in green because Booking Holdings is kind of the unsung hero of this industry. Booking has been a fantastic company to buy for a long time, right? This was one that really, really did quite well. Started in European, hotels, and for various reasons just became kind of the largest booking platform in Europe and then the United States as well too. But they've just also really done a good job of saying, hey, our shareholder policy is we're going to buy back shares. We're going to reduce our share count as aggressively as we can, but we're not going to do it without being methodical about it. We're going to base this on fundamental results. And they've just bought back shares continually at lower prices than where the stock was trading over the next 6 months. That's creating value for you as a shareholder. When your company is buying back shares low and then the stock goes higher, that's a very shareholder friendly capital allocation move. So Booking Holdings, it's in green. That's one of my favorite ones in the travel space. And then Trip.com, previously C-Trip, this is one that really suffered during the zero COVID policies that China had. It kind of just put a shutdown on the whole country, right? There was no intra-country traveling, and then also no inter-country travel as well. Kind of locked down on people coming into China and then also vacationing within the country's walls itself. But after those restrictive policies kind of came off, a couple years after 2020, it's now resuming, 15, 16% top line growth. And it invested in itself during the pandemic on things like AI, on things like chatbots, on things like, making the website even better and more efficient. And so while its competitors who didn't have as strong of a cash hoard to go to ride out this storm kind of folded and suffered really, really badly, I think that C-Trip, now Trip.com, got a lot stronger. And this is one that has been on the scorecard right since the pandemic in 2020. It's actually one of our best returners in the travel space because we got in when everyone else was kind of turning the other way and saying, okay, get out of China, get out of the travel industry. Pandemic is wreaking havoc everywhere. Yes, that narrative is true, but sometimes you can find really, really good stock opportunities when they're selling cheap, when everybody else is turning their back on certain things. So I still like Booking. I still like Trip.com. I still like Airbnb a little bit less than those other two because of capital allocation reasons. And the IPO they had a couple of years ago, which has still got some kind of vested equity for its insiders, not as appealing for public stockholders. But this is a limited space. We've only got 3 on the scorecard right now, but I really like the travel industry as a whole. I am all in on Airbnb for trips. I've got one coming up at the end of this weekend with some of my old buddies from college, 25 years ago. Crazy saying that now. But you tend to stick with the same platform. These companies continue to make more and more money, and they're buying back shares in the meantime. So that's the travel industry. There's a couple stock ideas. Any questions on that one, Heather? Do you use Airbnb? Do you use Booking, or is there anything that you prefer the most?
I've used I think I've used all of them. I mean, well, I haven't used the one in China. I've not been so lucky. No, I used Booking a lot this summer. We went to Maine with only 2 nights actually booked before we left. And so we were just flying by the seat of our pants. We were just every evening, we're just on hotels.com, like booking.com, just like, okay, gotta find somewhere to stay tonight.
Awesome.
And it was really fun and great, except for Maine is very busy in the summer, so it was a little bit wild, but it was a really fun adventure. And we have stayed in some great Airbnbs and some nightmare ones, but then they're just funny stories. So it's a good platform.
They are.
Have most of them recovered pretty well from COVID? It sounds like they have, and they used it as time to buy back.
Yeah, the good news is, this is one that most of these companies have got a lot of cash. They've got kind of deep pockets from making organic cash flows and not having to spend a ton on things. They do make acquisitions when the time is right. But the good thing, if there was any silver lining to 2020, is that the strong got stronger. I mean, just like we mentioned with Trip, which is China's Booking.com. Booking was the same thing. You got a bunch of, billions of dollars of cash on the balance sheet. Certainly it stings, when travel is down, but you kind of dip into that balance. And your competitors don't, have that same kind of luxury. I certainly have seen in the volumes, to answer your question, travel volumes have resumed to the pre-pandemic levels, both for Booking and for Trip and for Airbnb. So yes, I do think they, for the most part, recovered since the COVID pandemic there.
And then kind of a softball question. Um, how the year in review was for 2025, but it seems like it would be a really good primer for someone getting started with 7investing now to get a really good overview. It seems like the best place to start if you want to get started with 7investing for 2026. Would you say yes?
100%. Thank you for the softball question. Yeah, that was off script. That was a perfect one. I should have even said that myself. But yeah, it's scorecard is intimidating, right? You go out there and you see there's now. Let me buy the numbers. Get this right. I'm sure I've got this correct here. We now have on that 7investing scorecard 106 active recommendations. That's where do you start, right? There's 106 companies. If we didn't have any kind of guidance on where to begin, that might be intimidating if you're trying to figure out over 100 recommendations that are active right now. And by the way, there's 380 total recommendations we've ever made. We've searched under a lot of stones. And we said, okay, we follow these companies pretty well. Every report has got a what to watch for, and we generally kind of know, are things going well or are things not going well for companies? And we track them continually every single month. We said, let's give some guidance of what of our highest conviction ideas. And that was where the Best Buys idea came from. Of like, if you could only feature a couple companies every month, we'd say out of all of these companies we've got, here's the five that we feel the most strongly about, that are either mispriced or too cheap right now, or the growth is just too good, not respected by the rest of the market. Here's the very best ideas. And then we kind of said, okay, at the end of the year, keeping in mind that every month we've got these Best Buys coming out here, let's kind of broaden the peripheral vision once again and look at all the companies again, and not only look at the strongest Best Buy ideas, but where do they stand in the middle, and then also how do we do on those sell recommendations. Heather, if there's one thing I can say about investing as someone who's done this now professionally, coming up on my 14th year full time as a professional investor, I would say be iterative and methodical in your process, right? If you start here and this is where your process is, get a little bit better in 2026. Look at which of your buy recommendations worked out really well for you. Why did they work out so well? And then maybe look at some of the stocks you sold too soon or you didn't sell soon enough. Were your sell recommendations good or bad ones? Look at that methodically, make it a little bit better the next year. And then all of a sudden, you kind of start at your first year of investing here, and then you're at your fifth year here, and then your 10th year, and then your 20th year. And if you've got a really detailed process that you go through every year, you keep getting better at this, and your returns keep getting better too. And so that's why I always say this is a long-term journey. You cannot just look at one single month or one single quarter and assess performance as yourself as an investor, but also as a company too. It takes companies similarly time to do these kinds of things. And I think the year in review has been a fantastic way to do that. Again, I encourage everybody to check this out. It's a lot of good bedtime reading, but we've tried to distill it down. We put it sector by sector. We say, okay, got my coffee. I'm ready to dive into advertising, or today, and then tomorrow I'm going to go dive into to travel. Maybe the next day you want to look at enterprise software. Maybe the next day you want to look at semiconductors. We've got 17 sectors represented, and then based within each of those sectors, the highest to the lowest conviction ideas. So really a lot going on there, but it doesn't have to be as intimidating and crazy as it might have initially appear. We've tried to make this digestible, and that's the whole reason for the year in review in the first place. Heather, I might close this out unless there's any other dying questions you'd like to end with here for today's show.
No, I think that's a perfect place to end it. Thank you.
On that note, we appreciate you tuning in to today's show. Again, today is January the 12th, 2026. We took a look at our year in review one last time, 7investing.com/subscribe. It is absolutely free for your first 7 days. We got a free 7-day trial. The reason we do that is because we just want to say, hey, go nuts, go check out as much as you can of the platform, see the Best Buys, see the subscriber calls, check out the year in review, see everything that we've got to offer. And then if you love it and you want to see everything for the next month, January and then February and then March and everything else like that, we feel really strongly about what we're doing. And I love this every day. So 7investing.com/subscribe, free for your first week, $200 a year after that. On Wednesday's show, we've got the 14th coming out with Ari Hughes, a former colleague of mine who went and saw things on the institutional side of the investing market. He looked at a lot of things that I wasn't necessarily looking at from a 7 investing lens. And then before that, kind of a growth style lens. We're going to look at Constellation Software on Wednesday's show. Ari's done some really neat research here, and he's going to show us how do institutions look at stocks and how that might be different than how retail investors look at stocks. So excited about that show. We're going to take off on Friday and Monday for a Martin Luther King holiday, and then we're going to be joined by Steve Symington and James Early in the following week as well. Those are two fantastic investors. Excited to hear their perspectives on the show as well. So for January 12th, 2026, my name is Simon Erickson. I hope you enjoyed today's show. We'll see you again on Wednesday, and have a great week.